Hey, everybody, and welcome to the Dan Habib Show. I'm your host, Dan Habib. And for those of you that don't know me, I've been involved in the financial markets for the last 15, 20 years. I worked at Morgan Stanley as a financial advisor. I am currently the CRO, Chief Revenue Officer of MBS Highway, a platform designed to help mortgage and real estate professionals understand what's happening in the market, better time interest rate changes, have data for all kinds of markets across the country, and ultimately better serve the consumer in their goal for home ownership. I'm also a partner in Crypto Charts, which is an education platform specific to the cryptocurrency market to help investors really have an edge and really have every advantage possible when trying to understand and invest in the crypto space. And this includes technical analysis, breaking down projects in ways that you can understand, also taking a look at something that's unique to the blockchain, which is on chain analysis, and really getting a flavor for behavior and sentiment of investors out there, long term holders, different things of that nature. And also taking a look at some entry and exit points, as well as some leverage positions. So, have a pretty well rounded background in the financial markets. And really, the goal of this is to share my thoughts with you each and every week on what's happening in the market. And boy, there is no shortage of things to talk about in the current market. Now, are we headed for a recession? What's going on with inflation? We know inflation is right now the biggest problem, not just in the United States, but across the globe. And what the heck is the Federal Reserve doing, right? We know the Fed is tightening now. They're hiking the federal funds rate. What does that mean? Are they hiking mortgage rates? Well, we're going to take this week step by step and really give you a good macro view of what's happening in the economy, what it means for stocks, for interest rates, for cryptocurrencies. And each week, we're going to examine some of the latest economic data, break it down, hopefully, in ways that you can understand and maybe act on some of this stuff or utilize it in your business to be able to really be the expert and explain this to your customers, your referral sources. So, first things first, the biggest problem that we have right now in the globe is inflation. So, what is inflation? Well, the textbook definition is too many dollars chasing too few goods. Well, how did we get in this situation we're in right now where we're near 40-year highs in inflation? And listen, you guys all feel this, right? You go to the store, things cost more money. Your dollar, the buying power of it has been eroded. It doesn't go as far. So, first of all, let's tackle the too many dollars. Well, we've had trillions of dollars of stimulus. And of course, there was good intentions there to get us out of the COVID crisis that we were in. You also had the Federal Reserve that was very, very easy with their monetary policy. They kept one of their tools called the federal funds rate at zero for too long. They also did trillions of dollars of asset purchases. That includes buying mortgage bonds, buying treasuries. And what was the result of this? Well, it artificially kept interest rates low. And when that happens, it makes money cheap. And then people want to expand, they want to borrow. And it does do a good job of creating economic activity, but it puts a heck of a lot more money into the system. So you have too many dollars. And then, of course, on the other end of things, we kind of had a perfect storm where you had COVID that crippled supply chains, and they are still not back fully online where they should be. So you have too many dollars chasing too few goods. It's no wonder why we have very, very high inflation. So, what is the Federal Reserve trying to do about this? Well, Gavin, if you could pull this slide up, first of all, we know that they're making some drastic changes, but it's not very comforting to see our Fed chair, Jerome Powell, come out at the last meeting and say, well, we now understand how little we understand about inflation. Now, these are the people out there that are driving the ship, arguably have the most important job in the United States. And because the US is such a powerhouse in the world in dictating monetary policy, and their actions have a ripple effect and impact the economy to a great degree. So, the Federal Reserve, first of all, they thought inflation was going to be transitory or temporary. So they made that mistake. So they let things be too easy for too long. But now they've made a 180 and the Fed has now been tightening. The Fed has been hiking the Fed funds rate. And there's a lot of misconceptions out there about what the Fed funds rate is. It is not a mortgage rate. When the Fed hikes rates, that doesn't mean mortgage rates go up. The Fed funds rate is an overnight rate that banks lend to one another. It's a very short term rate. Now, it does have a direct impact on certain things: car loans, credit cards, short term treasuries, personal loans, small business loans. It makes all those things more expensive. So, certainly, it does have a slowing down effect on the economy. And let's face it, this is what the Fed is actually trying to do. They are trying to curb inflation. They can't do anything about the supply side. So they're trying to destroy, quite literally, the demand side of the economy to help bring down this inflation problem that we have. But counterintuitively, if the Fed gets inflation under control, it can actually be a good thing for mortgage rates because mortgage rates are most closely tied to inflation. But the Fed tightening, it can have unintended consequences. And some of those unintended consequences could be a recession. And we'll get into that. But here's the big question most people have: when is inflation going to abate? When is inflation going to start coming down? And very few people out there really truly understand how these inflation reports work. One of the main ones that the markets look at, it's called the Consumer Price Index report. Now, every single month, this report comes out and gives you a new monthly reading. The last reading we got for August was 0.1%. They also give you a year over year reading, which just went down from 8.5 to 8.3%. So it went down by 0.2. But how did that happen? Well, when we get this new August reading, it's a rolling 12-month basis report. That means that it grabs the last 12 months of monthly readings, adds them up, and gives you the year over year reading. What that also means is that we just replaced the August number from 2021. Now, because we replaced a number of 0.3 with a number of 0.1, you can see there that's a 0.2 difference. Well, it makes sense why the year over year reading went from 8.5 to 8.3%. But now that you know more than most people out there about how these reports work, you can take a look at the numbers going forward that we're going to be replacing from last year to get an idea of how much inflation may move. Here's what I mean. When we look to September, the reading was 0.4%. Now, if this is the first time you're looking at these inflation readings, these numbers here are all low numbers, which is why I've been saying that I think the summer months are going to be tough to really see a big decline in inflation because the bar is already set low from last year. Now, if we take a look and we get to the fourth quarter, you have a reading of 0.9 in October. Well, what does that mean? Well, imagine if we saw a 1/10 reading for October of 2022 and it replaced a 9/10 reading from 2021. That means you would see year over year inflation drop by roughly 0.8%, which would be huge. So here's my thoughts on inflation. I think it's going to be a little bit choppy, but I do believe by the fourth quarter, you're going to start to see inflation come down, and especially by the first quarter of next year. What does that mean? That means that we're going to see interest rates likely come down in the fourth quarter and the beginning of next year as well. Now, besides the comparisons getting tougher, you also have the Fed that is continuing to hike. And as we look to next week, the Fed is going to be hiking on September 21st by 75 basis points. We know that almost to be certain. Now, many people out there might think that that's a bad thing for mortgage rates. Well, listen, mortgage rates are going to react to inflation. But if you look at the last two times the Fed hiked 75 basis points, you actually saw interest rates come down a little bit. We may see that happen again. But the bottom line is by the fourth quarter, I think that the Fed rate hikes are going to finally start to really take hold and bite the economy. And the way I want you to think about this is it doesn't happen right away. The markets can react right away and try to handicap how much this is going to impact stocks, bonds. Think about it like this. If I was sick, I went to the doctor, I took some prescription medicine that they gave me. Well, 5 minutes later, I'm not going to be dancing on the tables, right? It takes a while for this to enter my immune system and then for me to start feeling better. Maybe it takes a couple days. Similar situation here with the Fed and hiking rates. It's not going to immediately curb inflation. It's not going to immediately make the economy slow down. It may take 3, 4, 5, 6 months to really feel the full impact of it. So I believe by the fourth quarter, you're going to start to see interest rates come down. You're going to start to see inflation come down. But here's the big question. Are we going to see a recession? Well, our Fed, and listen, I don't mean to be ultra critical here, but the Fed is a bunch of academics. Most of them haven't even as so much run a popsicle stand. Okay. So, they don't have real world business experience. And oftentimes they're either way too accommodative for too long, way too restrictive for too long, and they overshoot. And in my opinion, part of the reason why we see these boom and bust cycles in the United States. And Fed Chair Jerome Powell and many of the Fed members, they say, well, you know what? It looks like a soft landing. Do you know what that means? That means the Fed believes they can hike, and slow down the economy and curb inflation without sending us into a recession. In my opinion, it's like Jerome Powell here on this little canoe, and he doesn't see that there is Niagara Falls here that he's about to go over. Okay. So when we take a look at some of the indicators out there, take a look at history. Every time you've seen the Fed go on a rate hike cycle, which this white line here is your Fed funds rate, and these blue vertical lines are your recessions. Every time you see the Fed hike rates, hike, you get a recession. Hike, recession. And you could see almost every instance that occurs. And there's also other indicators out there that we're seeing. A normal yield curve looks like this, up and to the right, meaning if you put your money away for 10 years versus 2 years, you would expect to get a higher rate of interest for putting your money away for a longer period of time. That's normal. However, current environment, it's what's called an inverted yield curve. Right now, the 2 year yield is about 30 basis points higher than the 10 year. Now, that sounds backwards, upside down, or inverted. Why? Because there's so much risk and fear in the short term that you're being rewarded to a higher degree than in the longer term. This is a sign or a symptom of weakness in the economy. And if you look at the pattern, it's pretty clear. Every time you see an inversion, this line turns red. Inversion, recession, inversion, recession, inversion, recession, every single time. And we are pretty deeply inverted here now, team. Now, another thing that you see the Fed governors out there saying, and this is Fed Governor Waller, he says, I can't see a recession because the unemployment rate's at 3.7%. Yes, that is a historical, very low level of unemployment. It has gone up from 3.5%, but again, they're not seeing how these things work. You never get recessions when the unemployment rate's at its highest point. You get a recession when the unemployment rate's at its lowest point and then begins to turn higher. And you can see in every single market cycle with 100% accuracy, the recessions begin when the unemployment rate's at its low and turns higher, and then you get the recession. You know what happens when you're at the highest point? That's when you actually start the next economic expansion. Now, why does this phenomenon happen? Well, it makes sense if you think about it. So, if companies are doing well and the economy is booming, the labor market's going to be tight, unemployment's going to be low. But once things start to slow down, what occurs? Businesses, they start to feel it, they stop hiring, and then unfortunately, they have to reduce headcount. Now, when they reduce headcount, those newly unemployed, they're going to have to change their spending behavior. They're not going to go to the movies, to the retail stores, out to dinner, and all those businesses that were relying on that money, they're going to contract, they're going to reduce headcount. And that's when you see this kind of explode and the unemployment rate goes high to the upside. So the argument that people are making out there that we are not headed for a recession because the unemployment rate's too low, that's precisely when you get a recession. Now, how about this fact? I don't know about you guys, but as long as I could remember through any of my economics classes, a recession is defined by 2 consecutive quarters of negative GDP. It seems like they're trying to change the rule book here now, but Q1 was negative 1.6%. Q2, after the revision, is negative 6 tenths. Looks like 2 consecutive negative quarters to me. But now the NBER, who is the referee for this thing, and they determine if we're in a recession or not. First of all, they always wait. So it's always backward looking. It's never like, hey, we're in a recession right now. It's like, oh, 6 months ago, we were in a recession. So we very well may be in a recession currently. However, they say they want to see a certain amount of economic contraction that meets their goalposts, that it's deep enough, that it's long enough, and that it's diffused enough throughout the economy. But here's something worth noting. We have never seen 2 consecutive quarters of negative GDP, and it hasn't been classified as a recession. So, team, the bottom line is this. I certainly do believe that we're going to continue to see a slowdown in the US. We are going to see the United States, if we're not already in one, head for a recession. So, what does that mean for different parts of the economy? Well, for the housing market, I actually don't think it's a bad thing. Interest rates always come down during recessionary periods. Right now, they're elevated. They're around 6%. That is historically not that bad, but coming off the levels we were at, it's slowing, transactions to a high degree, right? Refinances, a lot of people refied at lower levels. Refis are down 83%. Purchases, application data is showing we're down 29%. But I do think with half the mortgages out there above 4%, half below 4%, when we see the fourth quarter, beginning of next year, inflation come down, potential recession like conditions, I think you're going to see interest rates come down. I would not be surprised if next year we see interest rates with a 4 handle in front. And I think that will spur a lot more activity in the mortgage and real estate markets. How about the stock market? Well, I've thought the stock market has been overvalued for quite some time. I happen to listen to a lot of earnings calls out there. Just heard from FedEx, a lot of companies out there giving pre-forward guidance here on Q3 earnings, which we're going to be getting soon, saying that this is a very, very difficult quarter. Things are slowing down, things are getting worse. FedEx saying, I think we're in a global recession. The only one that doesn't see that we're in a recession out there is the Fed, apparently. Even the World Bank came out today. You know what they said? They said it looks like we are seeing a synchronized effort of central banks slowing things down, hiking rates to curb this global inflation problem. And they think we're going to enter into a global recession. So, if that's the case, what does that mean for risk on assets? Well, unfortunately, team, I believe we're going to see the stock market move much lower, maybe 20% lower from current levels. One of the targets I have on the S&P 500, 3,200 or so. What does that mean for cryptocurrencies? It means that I think cryptocurrencies as a whole are going to move lower as well because there's a high correlation of cryptocurrencies to the stock market at a very high degree currently. When you look at Bitcoin compared to the Nasdaq, Bitcoin compared to the S&P, to the Dow, we're talking 85% correlation, 90% correlation at times. So because of the market participants, they're selling the bath with the bathwater. And if we see stocks come down, you're going to see cryptos come down as well. So what's the advice? Well, listen, if you're a long-term holder here for these things, I think you're going to be just fine. If you want to be a little bit more speculative, well, anytime you see these rallies, in my opinion, these are bear market rallies. I think they're opportunities to reduce exposure. But the main thing is this: whether or not you change your current positions, I truly believe you want to have dry powder on the sidelines because I believe over the next 6 months or so, you are going to have a multi generational investment opportunity in both stocks, but really in cryptocurrencies. Imagine seeing a $500 Ethereum price or a $12,000 Bitcoin price. Is it possible? It certainly is. Don't quote me on those numbers, but I think you will have the opportunity to buy in on some of these really strong cryptocurrencies at lower prices. And come the next few years, especially after you see the next halving cycle with Bitcoin, I think people will look back and say this has been a multi generational investment opportunity. Hey guys, until next week, I hope you guys have a great one, and we'll catch up on the latest breaking news, and we'll cover the Fed meeting that happens next week in the next episode. Take care.